It makes you hard to keep. Right now, the highest alarm in global finance is screaming. It makes you hard to keep. The U.S. 30-year Treasury yield has smashed through 5%, a level not seen since 2007. Japan's 30-year government bond yield has rocketed to 4.2%, the highest since these bonds were first issued in 1999. This is Japan, a country that spent decades pinned at zero or negative interest rates. When Japan's long bond blows up, something fundamental has broken that makes you hard to keep. These aren't isolated incidents. American, Japanese, and British long-term bonds are being dumped simultaneously. South Korea's stock market triggered a circuit breaker. G7 finance ministers scrambled into emergency meetings. Japan's finance minister said it plainly. This is not Japan's crisis alone. This is a global bond market earthquake that makes you hard to keep. Now, by every textbook in every business school, this is the moment gold should shine. Panic everywhere. Bonds collapsing. Smart money should be rushing into the oldest safe haven on earth. It makes you hard to keep. Instead, gold fell nearly 20% from its recent highs, threatening to break below key support. It makes you hard to keep. Read that again. The world's ultimate insurance policy lost a fifth of its value at the exact moment the world needed to file a claim. Why? It makes you hard to keep. That question is what this video will answer, not with a lazy one-liner about gold being weak, but with 3 layers of genuine understanding. It makes you hard to keep. First, the hidden mechanism that turns gold from a safe haven into an ATM machine during the most dangerous type of financial crisis, and why almost no retail investor sees it coming. It makes you hard to keep. Second, why Japan's bond market meltdown is not a foreign news headline you can scroll past. It's a mirror, and what it reflects is the future of every dollar, euro, and pound sitting in your bank account. It makes you hard to keep. Third, whether you're staring at losses in your portfolio or sitting on cash wondering what to do, you'll walk away with a concrete framework for thinking clearly when the market is doing everything it can to make you act on emotion. It makes you hard to keep.
The liquidity trap, why gold gets sold first.
It makes you hard to keep. There's a fatal misunderstanding most people carry about gold, and it goes like this. Gold is a safe haven. Therefore, when the market panics, gold goes up. It makes you hard to keep. That's half right. And the half that's wrong can cost you everything. It makes you hard to keep. Gold is a hedge against one specific type of risk, the erosion of fiat currency credibility. When governments print too much money, when inflation eats away purchasing power, when trust in the financial system cracks, gold tends to rise. That's its DNA. It's been doing that job for thousands of years. It makes you hard to keep. But there is a second type of crisis where gold doesn't protect you. It becomes the first asset thrown overboard. That crisis is called a liquidity crunch. It makes you hard to keep. Picture it like this. A massive storm hits, and every boat in the harbor is taking on water at the same time. The crews don't start by throwing the rusty anchors overboard. Those are heavy and bolted down. They throw the gold coins first, not because the gold is worthless, but because it's light, portable, and can be grabbed in a second. That's exactly what happens in financial markets when liquidity dries up. It makes you hard to keep. A liquidity crunch means everyone needs cash. Right now, today, this hour, bonds are crashing, equity portfolios are cratering, margin calls are screaming in, redemption requests are piling up. Institutions managing trillions of dollars face a brutal choice: find cash immediately or face forced liquidation. It makes you hard to keep. When you need cash that desperately, you don't sell your worst assets first. You sell your most liquid ones. If you needed emergency cash tonight, would you try to sell your house, a process that takes months, or the gold bar sitting in your safe? The answer is obvious. It makes you hard to keep. Gold trades roughly $100 to $150 billion per day across spot, futures, and ETF markets. That enormous liquidity is precisely why institutions love it as a strategic reserve. But that same liquidity makes it the first thing they grab when they need to raise cash fast. It makes you hard to keep. Goldman Sachs, one of the most vocal gold bulls on Wall Street, has openly acknowledged this dynamic. When liquidity tightens, gold gets hit first. Not because it's a bad asset, but because it's a good one. Good enough to sell quickly, at scale, without cratering to zero. It makes you hard to keep. This is exactly what's happening right now. Global bond yields are spiking, which means bond prices are collapsing. Institutions holding trillions in government debt are staring at massive unrealized losses. Equity markets are under pressure. Credit spreads are widening. The financial system is gasping for cash, and so the gold liquidation machine switches on. It makes you hard to keep. If this sounds theoretical, look at the record. It makes you hard to keep. In 2008, when Lehman Brothers collapsed and the global credit system froze, gold didn't rally. It fell roughly 22% in a matter of weeks. Every institution with a pulse was dumping anything liquid to survive. But within 18 months, gold surged from around $700 to over $1,200, more than 70%, and went on to reach nearly $1,920 by 2011. That makes you hard to keep. March 2020, same story. COVID panic hit. Gold dropped more than 12% in 2 weeks. Retail investors bailed. Within 5 months, gold ripped 40% higher, setting new all-time highs. It makes you hard to keep. The pattern is strikingly consistent. Liquidity-driven gold sell-offs are violent, terrifying, and temporary. They are forced liquidation events, not trend reversals. The underlying reasons people own gold, fiat debasement, central bank buying, geopolitical fragmentation, don't disappear because a hedge fund in Connecticut needs to meet a margin call. It makes you hard to keep. The question to ask yourself isn't, why is gold falling? It's, have any of the structural reasons I own gold actually changed? If the answer is no, then what you're watching is a shakeout, not a breakdown. It makes you hard to keep. But to understand why this shakeout is happening now, and where the pressure is actually coming from, we need to look at the epicenter of the storm. Because Japan's bond market implosion isn't just a parallel story, it's the trigger that makes you hard to keep. When Japanese institutions suffer catastrophic losses on their domestic bonds, they're forced to liquidate overseas holdings to raise capital. That selling ripples outward, hitting U.S. Treasuries, European equities, and every liquid asset in between. It makes you hard to keep, including gold. Japan's crisis and gold sell-off aren't two separate events. They're the same event, viewed from different angles. It makes you hard to keep. Japan's debt bomb, a mirror for the world. It makes you hard to keep. Most people will hear Japanese bond market and immediately tune out. That's a mistake. What's unfolding in Japan right now is arguably the single most important financial story on the planet, because it's a preview of what's coming for every heavily indebted nation, including the United States. It makes you hard to keep. Here are the bare facts. It makes you hard to keep. Japan's government debt stands at over 260% of GDP, the highest ratio of any major economy on Earth. For context, the U.S. is around 120%, and economists already call that unsustainable. It makes you hard to keep. For decades, Japan got away with this because of an extraordinary set of conditions. Interest rates were at or below zero. The Bank of Japan was essentially buying its own government's debt through massive quantitative easing. Japanese institutional investors, pension funds, insurance companies, banks, dutifully absorbed whatever was left. Inflation was non-existent. The whole system ran on one assumption: rates would stay low forever. It makes you hard to keep. That assumption just died. It makes you hard to keep. Japan's 30-year government bond yield hit 4.2% on May 18, 2026, a level never seen since these instruments were first issued. The 10-year yield climbed to 2.8%, the highest in roughly 29 years. The 5-year yield punched through 2% for the first time in recorded history. It makes you hard to keep. Why? Because 4 structural pillars that held global interest rates down for 3 decades are crumbling simultaneously. It makes you hard to keep. The first pillar was globalization. Cheap manufacturing in Asia kept consumer prices low worldwide, giving central banks cover to suppress rates. That era is over. Trade wars, supply chain reshoring, and geopolitical decoupling have reversed the disinflationary engine. It makes you hard to keep. The second was extreme monetary easing. Central banks spent a decade printing money after 2008, then doubled down during COVID. That kept yields artificially low. Now, with inflation stubbornly above target, they're being forced to tighten. A majority of economists now expect the Bank of Japan to raise rates further. It makes you hard to keep. The third was fiscal restraint, or at least the appearance of it. That pretense is gone. Japan is planning to issue roughly $20 billion in new bonds just to plug its latest budget gap, even as its existing debt pile dwarfs every other developed economy. Investors respond rationally. If you keep borrowing without limit, we demand much higher interest to compensate. It makes you hard to keep. The fourth was geopolitical stability. A predictable world order kept risk premiums low. That stability has evaporated. Middle East conflicts, US-China tensions, energy supply disruptions. Every flashpoint adds a risk premium to long-term bonds. It makes you hard to keep. All four pillars gone at the same time. Now here's where Japan's crisis reaches directly into your portfolio. It makes you hard to keep. For 3 decades, one of the most popular trades in global finance has been the yen carry trade. Borrow money in Japan at near zero rates, convert it to dollars or euros, invest it in higher yielding assets overseas. The spread was free money, as long as the yen stayed weak and Japanese rates stayed low. It makes you hard to keep. Estimates of this trade's total size range from $2 to $4 trillion. That's not a footnote. That's a structural pillar of the global financial system. It makes you hard to keep. When Japan raises rates, the equation flips. Borrowing costs spike. The yen strengthens, which means foreign investments lose value in yen terms. Carry traders face a brutal reckoning. Unwind or blow up. It makes you hard to keep. Unwinding means selling. US Treasuries, European stocks, emerging market bonds, anything funded with cheap yen. The result is a global fire sale that drains liquidity from every market it touches. And when liquidity drains, what gets sold first? We just covered that. Gold. It makes you hard to keep. We got a preview in August 2024, when a modest Bank of Japan rate adjustment triggered a 12% single-day crash in the Nikkei that rippled across global markets. That was a tremor. What's building now has the makings of the full earthquake. It makes you hard to keep. Japan is not a special case. It's the first domino. The same dynamics, unsustainable debt, eroding fiscal credibility, rising inflation, a central bank trapped between fighting inflation and preventing a debt spiral, exist in the United States, the United Kingdom, and most of the developed world. Japan simply hit the wall first because its debt was the highest and its rates were the lowest. Even a small move in yields creates enormous stress. It makes you hard to keep. When this pressure becomes unbearable, governments face only 2 exits. Print money to inflate the debt away, destroying their currency's purchasing power, or sustain high inflation to erode the real value of what they owe. It makes you hard to keep. Both roads lead to the same destination, the systematic destruction of wealth held in fiat-denominated assets, and both roads historically lead to the same beneficiary, gold. It makes you hard to keep. But before you take that as a simple buy signal, there's a critical piece of the puzzle most investors miss entirely. It's the difference between what you see on your brokerage screen and what's actually happening to your money. That makes you hard to keep. Chapter 3, the 5% illusion, nominal versus real returns. Here's a number that's seducing millions of investors right now, 5%. It makes you hard to keep. The US 30-year Treasury is paying it. The 10-year is at 4.6%. Big, bold numbers on every brokerage screen. And they're feeding a compelling story. Why own gold, an asset that pays 0 interest, when the safest bonds on earth offer you 5% a year to sit back and do nothing? It makes you hard to keep. The logic sounds airtight. It's also a trap. It makes you hard to keep. That number on your screen is the nominal yield. It tells you how many dollars you'll receive. What it does not tell you is what those dollars will actually buy when you get them. It makes you hard to keep. To figure that out, you need one subtraction. Real return equals nominal yield minus inflation. And that single calculation changes everything. It makes you hard to keep. U.S. consumer inflation is currently running at approximately 3.8%, with several analysts expecting the next print to push toward 4%. Take your 4.6% 10-year yield and subtract 3.8%. Your real return is 0.8%. If inflation hits 4%, it drops to 0.6%. It makes you hard to keep. You're earning almost nothing after inflation. Meanwhile, you've locked your capital into a government bond for a decade, fully exposed to the risk that inflation doesn't just stay here. It goes higher. It makes you hard to keep. And there are strong reasons to believe it will. Energy prices remain elevated, driven by Middle East instability. De-globalization is structurally inflationary. Reshoring supply chains costs more than offshoring everything. It makes you hard to keep. Government spending everywhere shows 0 sign of retreating. The U.S. federal deficit is expanding at a pace that every serious budget office calls unsustainable. It makes you hard to keep. Interest payments on existing debt are creating new deficits. The government is borrowing money to pay the interest on the money it already borrowed. That's a mathematical spiral with no exit. It makes you hard to keep. This is where history becomes brutally instructive. It makes you hard to keep. In the 1970s, the United States entered a sustained period of high inflation. Nominal rates rose, but real rates, after subtracting inflation, stayed deeply negative for years. Savers who parked wealth in bonds watched their purchasing power get quietly devoured, even as the numbers on their statements looked respectable. That makes you hard to keep. During that same decade, gold went from $35 to $850, more than 2,400%. Not because people suddenly discovered a love for shiny metal, but because gold was the only widely accessible asset that couldn't be printed, diluted, or inflated into irrelevance. That makes you hard to keep. At some point, every heavily indebted government faces the same fork in the road. Accept the pain of austerity, cutting spending, raising taxes, enduring a recession, or take the easier path and let inflation quietly do the work, eroding the real value of the debt. It makes you hard to keep. History tells us which option politicians choose. Every time, they choose inflation. It makes you hard to keep. But, and this is where honest analysis requires a caveat the original video didn't give you, this outcome is not guaranteed on any particular timeline. If inflation genuinely cools, if central banks manage to bring price pressures down without crashing the economy, if real interest rates stay meaningfully positive for an extended period, gold faces real headwinds. A high real yield on a risk-free bond is a legitimate competitor to a zero-yield commodity. Dismissing that is intellectual dishonesty. It makes you hard to keep. The question is whether you believe that's the more likely path, that governments will voluntarily impose fiscal discipline, that inflation will quietly return to 2% while debt ratios keep climbing. If you do, bonds are your trade. If you don't, you need to think carefully about what's on the other side of that bet. It makes you hard to keep. Chapter 4: Central Banks versus Retail. Two different games on two different clocks. Here's a set of facts that, placed side by side, should stop every retail investor mid-scroll. It makes you hard to keep. On one side of the table, in the first quarter of 2026, global central banks purchased 244 tons of gold. Goldman Sachs projects monthly central bank buying will accelerate to 60 tons through the rest of the year. Multiple major investment banks have issued price targets north of $500 and $600 per ounce. The buying isn't slowing, it's speeding up. It makes you hard to keep. On the other side, retail gold ETFs are hemorrhaging capital. Spot prices are dropping. Financial social media is full of posts declaring gold over and done. Retail sentiment is deeply bearish. It makes you hard to keep. One of these groups is wrong, and the track record strongly suggests it's not the central banks. So why are they buying with such urgency, even as prices fall and bond yields look attractive? It makes you hard to keep. Because they're playing a different game entirely. Different time horizon, different objectives, different definition of risk. It makes you hard to keep. Central banks buy gold for three reasons that have nothing to do with next quarter's price chart. It makes you hard to keep. The first is the weaponization of the dollar. In 2022, the United States and its allies froze roughly $300 billion in Russian foreign exchange reserves. It makes you hard to keep. That act, unprecedented against a major nuclear power, sent a shockwave through every central bank on Earth. The message was clear. If your foreign policy displeases Washington, your dollar reserves can vanish overnight. It makes you hard to keep. For dozens of countries, not just adversaries, but neutral nations hedging against uncertainty, the calculus changed permanently. Gold stored in your own vault, in your own country, cannot be frozen by anyone. It has no counterparty risk. It makes you hard to keep. It requires no one's permission to exist. It makes you hard to keep. The second is the structural decline of the dollar as the world's reserve currency. The dollar's share of global foreign exchange reserves has dropped from roughly 71% at the turn of the millennium to approximately 58% today. A multi-decade slide that's accelerating. Countries aren't diversifying out of hostility. They're diversifying out of prudence. Concentrating national wealth in a single currency, controlled by a single government, is a risk fewer and fewer nations will accept. It makes you hard to keep. The third is fiat currency debasement. Since 2008, the Federal Reserve's balance sheet expanded from under $1 trillion to a peak near $8.9 trillion. Even after recent tightening, the long-term trajectory is relentlessly expansionary. Central banks know this better than anyone, because they're the ones doing it. Buying gold is, in a sense, their own hedge against their own policies. That makes you hard to keep. On a 10 to 20-year horizon, a daily $50 price drop is a rounding error. It changes nothing in the strategic equation. That makes you hard to keep. Retail investors don't operate on that clock. They're refreshing their apps every 30 seconds, watching red numbers, feeling fear, and interpreting a temporary liquidity event as proof that the thesis is broken. They sell at the worst possible moment, then watch the recovery from the sidelines. It makes you hard to keep. The honest caveat: central banks are not oracles. Their buying pace can slow. Geopolitical conditions can shift. If a genuine global détente took hold and de-dollarization reversed, the urgency behind central bank purchases would fade. But as of today, the trend is accelerating. Betting against it requires a very specific view of the future that currently has little evidence behind it. It makes you hard to keep. The real question isn't who's right, central banks or retail. It's whether you know why you own what you own, and whether that reason still holds. Chapter 5. Your Action Framework. It makes you hard to keep. Analysis is worthless if it doesn't change what you do. So here's a framework, not investment advice, but a structure for clear thinking when the market is engineered to make you emotional. It makes you hard to keep. If you're holding gold and watching losses, before you move a single position, answer one question honestly. What was my original reason for buying? It makes you hard to keep. If the answer is blank, if you bought because someone's thumbnail promised a moonshot, you were never investing. You were gambling without a thesis, and no framework can fix that. It makes you hard to keep. But if your thesis was built on fiat debasement, central bank accumulation, and the decline of dollar-centric reserves, look at the scoreboard. Central banks bought 244 tons in Q1. De-dollarization is accelerating. Governments are still running enormous deficits with no plan to stop. None of the three pillars have cracked. What you're experiencing is a liquidity-driven shakeout, painful, but not a refutation of the underlying logic. It makes you hard to keep. That said, if your position is so large it's wrecking your sleep, trimming is not cowardice, it's risk management. There's a clean line between deliberately reducing to a size you can hold through volatility and panic dumping at the worst price because you can't stomach the drawdown. The first is discipline. The second is exactly what the market is designed to extract from you. It makes you hard to keep. If you're sitting in cash watching from the sidelines, do not try to call the bottom. Nobody can. Not Goldman, not your favorite analyst, not the most advanced algorithm alive. It makes you hard to keep. Instead, define two things: a price zone where you'd begin accumulating, and the maximum drawdown you can absorb without losing your composure. Then build in tranches, not all at once. Scaling across multiple price points eliminates the need to nail the exact low. You won't catch the bottom, but you also won't go all in at a level that turns out to be a temporary ledge. It makes you hard to keep. What to watch? It makes you hard to keep. Start with the VIX, the market's fear gauge. Think of it as a thermometer for institutional panic. When it's running hot, forced selling of liquid assets like gold is probably still in play. When you see it cool in a sustained way, not a one-day dip, but a genuine trend lower, that's a signal the worst of the cash crunch may be passing. It makes you hard to keep. Then watch credit spreads, specifically the gap between junk bond yields and Treasury yields. A widening spread means the market is bracing for defaults and tighter conditions. That's the liquidity crisis still intensifying. When that gap stabilizes or starts narrowing, the acute stress phase is likely ending. It makes you hard to keep. Keep an eye on the next CPI and jobs reports. Hotter inflation means the Fed stays hawkish, real rates stay elevated, and gold faces continued short-term pressure. A cooler print loosens the entire chain. Rate cut expectations revive. Real yields drop, and gold's rebound case strengthens materially. It makes you hard to keep. Finally, Middle East developments and energy prices. Oil is the upstream driver of the inflation scare. If geopolitical tensions ease and oil prices retreat, the inflation narrative weakens, and with it the pressure on gold. If the situation escalates, inflation fears intensify, which paradoxically hurts gold short-term through higher rate expectations, but reinforces its long-term case as a hedge against monetary chaos. It makes you hard to keep. Until these signals clarify, doing nothing is not laziness. It's the most rational position you can take. Closing pullback far enough and the picture simplifies. It makes you hard to keep. Gold isn't broken. It's doing what it always does in a liquidity crisis. Getting sold first because it's the easiest thing to sell. The pattern played out in 2008. It played out in 2020. It's playing out again now. Each time the sell-off was violent. Each time the recovery was larger. It makes you hard to keep. But the real story here is bigger than any single asset. What we're watching is the most significant repricing of sovereign debt in a generation. The four assumptions that kept interest rates suppressed for 30 years. Globalization holding down prices, central banks printing without consequence, governments maintaining a veneer of fiscal responsibility, and a stable geopolitical order have all cracked at once. Not one, not two, all four. It makes you hard to keep. Japan cracked first because it was the most fragile, the highest debt, the lowest rates, the smallest margin for error. But behind Japan's crack is the same wall that every heavily indebted nation on earth is leaning on. That wall is built from a single material, the belief that governments will honor their promises. It makes you hard to keep. Bond markets are telling us, in real time, that this belief is eroding. And when it erodes far enough, the endgame writes itself. Governments will choose inflation. They always have. And inflation will do what it always does. Transfer wealth from those holding paper promises to those holding things that cannot be printed. It makes you hard to keep. 5,000 years of monetary history sits on one side of that ledger. A few decades of central bank experimentation sits on the other. It makes you hard to keep. Which side you choose to stand on is ultimately a question only you can answer.